Today, ladies and gentlemen, we're in the Goldilocks zone. I'm going to explain to you what that is for the market. I'm going to break down something to do with REITs because all of you seem to think REITs are better than real estate, but I don't think so. And then we're going to finalize with something that has to do with my first index funds I've ever purchased. So let's jump right into this. Welcome back, not passive income investors. Today, the Federal Reserve Chair, I think it is Jay Powell, said that we're in the Goldilocks zone of the stock market. We're not too hot, we're not too cold, and we're stuck right in the middle between tariffs, China, this interest rate thing going on. Everything's in this really nice balance that keeps sending the market into all new time highs, which also led me to purchase some index funds, which I'll break down in a little bit. But it's nice to know that we are in this nice, comfortable balance that is the nature of the stock market. It kind of takes away that volatility to an extent. But I want to talk about REITs really quick before we head over to the computer and break down my purchases and what is going on with my stock portfolio. But everyone's been talking about REITs. I've been finding a ton of videos lately about everyone's comparing REITs to real estate, and they think REITs are outperforming real estate, and they really micro analyze parts of the charts too. I want to show you a full chart of like a REIT index, and a lot of people say, oh, this year the REITs are outperforming the stocks, but when you look over the long-term charting, guys, you could have bought it like somewhere in 2007 and it'd almost be worth what it is today. That's what you have to understand about REITs. You're buying them for the dividends, and you're not buying them for leverage. You're not buying them to live, to manage your life, or anything like that for the matter. You're just buying them strictly for dividends. What do I mean by that? Well, I mean, if you buy a property, you might not be getting the rate of return that you might get from REITs. But the fact of the matter is, say a REIT goes up 20%. Well, how much money did you have in that REIT? 20 grand, 30 grand? Good for you, right? Well, your house went up 8%. How much money do you have in your house? 200,000, 300,000, 400. You've only put what, 50, 80,000 down into that property. You're playing with the bank's money. So even though the rate might be a little lower than REITs are currently paying out, the fact is you're going to be leveraging a lot more money. And on top of that, you're going to be able to get credit. You're going to be able to leverage that property maybe into another home. You cannot leverage REITs. You can't buy a REIT and then go say, oh, I own real estate. You should sell me a house, or you should sell me a line of credit, or whatever, which is good news, by the way. I just got an email that I'm actually approved for my $7,500 line of credit. So up yours, Dave Ramsey. I am getting credit. I might not use it, but I need it because if I do want to get a house down the road, I have to show some form of reliability and credit. So we start with the line of credit, $7,500 at 10%, everybody. Terrible percentage rating, but as I've been told, every 3 to 6 months, I can actually raise that limit. And as the amount goes up, the interest rate comes down, which is something that I've been commenting a lot on YouTubers' pages. It blows my mind that having a credit card doesn't mean anything. I've had a credit card for a long time. I even upgraded my credit card from $1,000 to $7,500 once upon a time. But that credit card was for a 20% interest rate that never changed as much as that number went up. And that started to bother me a lot. And then I found out when I was trying to apply for a line of credit that they looked at my credit card the same way they looked at my phone bill. And they're like, oh, well, the only two things we can check your credit on is your phone bill and the credit card you're using, which doesn't mean much because it doesn't lead you to getting a house. None of that matters. The only thing they care about is basically, essentially, have you paid your phone bill for the last decade? Sure, good for you. Paid your credit card off, your shitty little $1,000, $2,000, $5,000 credit card off your whole life? Good for you. Okay, so we know you can pay credit, but do you have income? Then they're going to look at your income statements, and that's where it really comes down to what matters. But if you're leveraging property, you have real things to leverage, the banks will just giddy up and smile to hand you credit, so long as you have some form of equity, which I have none of. So that's what I'm building toward. That's why I got credit. So when we're talking about REITs, guys, I don't want you to get too caught up in a lot of these people kind of throwing REITs down your throat. REITs are good. They have a place in a portfolio of diversified selections for income, of course. But if you're not putting it in a tax-free savings account or an RRSP, you can't really fully utilize those dividends to the full extent because you also get taxed as regular income on dividends. So say you make $30,000 or $40,000 a year, well, this will be included on top of that income, so you'd be taxed the full tax bracket with your regular income. So be careful with REITs, guys. They do have their ups and their downs, but they are an interesting part of the market. So let's head over to my portfolio. We'll break everything down for you guys, and just enjoy this Monday. So come on with me. Come on, guys. Let's go. All right, guys, before we get into the portfolio, I'm just going to recommend that you guys do what I do here. A lot of people wonder where you get the news from, and what I'm going to suggest is whether it is a realtor mail list, whether it is a big financial firm like Edward Jones. I also use something like Stocks to Trade. You want to sign up to at least 5 to 10 different mailing lists that are directly in this world, guys, because it is nice to see what the big firms think, what the little guys think, what the stock forums think, and see if you can find a middle ground between all of this, because this is where I got the Goldilocks and the 3 rising uncertainties. If you want to read this article, guys, it is absolutely brilliant. You can just pause it here and full screen it. The GIF of it is just in this beginning part. Maybe I'll scroll down a bit here as well so you can read the rest of it. But they really kind of go over basically all the stuff going on and how we're sitting in this really sweet zone where the markets seem to keep going up. I'm not going to go through all this now because it's a lot, and I kind of explained the brief Jiffy Lube of it in the beginning, but those are kind of the email lists that I'll sign up to. But let's hop into the accounts here, guys. We can see that my 3 brand new accounts, well, my 1 new account, but my 3 regular accounts, but they've been kind of new because we've opened up some US trading. But we can see I finally contributed to my RRSP, which is going to save me, this $4,000 is going to save me roughly 20%, which what's 20%? If 20% of 10,000 is 2,000, 5,000 is 1,000, which means it's probably saved me about $800, give or take, on 4,160 that I just contributed to this from selling Constellation brands. And we'll get right into that in a second, but let's just check out all the accounts real quick, see what's going on in the markets. As we can see, guys, the overall account sitting right at that 111,000 mark, not really going up too much or going down because of my bank stocks have been insanely just keep continuing lower while my other stocks go up. So while my other stocks go up and the banks go lower, it's kind of been balancing out my whole portfolio, and that is obviously why we diversify. Now, a lot of people are doing very, very well with what are they called? Like the non-discretionary stocks or the non-cyclical stocks like Johnson & Johnson, Procter & Gamble. For some reason, those stocks are excelling this year, and I don't have any of them in my portfolio. I have been actually analyzing Johnson & Johnson. I used to own Procter & Gamble. I wish I held on to it. I was an idiot. I think I overtrade. I'm progressively learning here with you guys, so I hope you're picking up some tidbits. But those are companies that I'm looking into maybe adding back into the portfolio, or my or even just use to I'll explain more about that in a sec. Let's just keep looking at the portfolio here. So we got Northland Power. It's kind of come back a little bit, so I could have got a good swing out of this actually if I kept the shares that I sold out of it instead of buying BTI. I bought back into NPI. I knew it was trading at quite a high multiple when I sold it there. BTI not down very much. I bought it when the Canadian dollar was up, so it hasn't really done anything at all movement wise, which is what I want because I'm literally holding this as a dividend play in my tax-free savings account. I think British American Tobacco and Altria Group are going to be some incredible dividend payers in the future to come, guys. And I honestly think these guys are sitting right at their bottom. You know, when Warren Buffett says when you're playing in that field, you always want to make sure there's like a risk tolerance level where essentially you're looking for the lowest mitigated risk by buying a stock at its closest to value option. And I honestly don't think British American Tobacco can really drop much lower than this. I can't see it with the fundamentals it has. So I think you're literally buying this company at almost its base value. GEO is another one that's been under fire lately, but for it to be sitting where it's sitting, it's actually not down that much. I'm kind of shocked that I'm only down 17%. Maybe because I bought it when the dollar was up as well, paying out a 10% dividend yield. This company's been under fire even though their balance sheet has been going up, which usually means if income goes up, balance sheet goes down. Or sorry, if income goes up on balance sheet and stock goes down, it's usually a good sign of an undervalued stock, considering it's been hedging down. So I'm going to actually set this up on a drip very soon, or just try and buy a few more shares of it because it's nowhere near the level I want it to be at. So I'm comfortable with it dropping even a little bit more, to be honest. I wouldn't mind trying to get these 10% yields, just because it's the only real estate I know that will probably continue paying a dividend no matter what. I really don't see that company not paying a dividend ever. It's a jail company, guys. I talk about it all the time, especially recently with all the news going on. But obviously Microsoft and SO being another part of my utilities. But Microsoft's just been killing the game lately. Like, look at this 34% gain. Too bad I didn't own a little more, but you got to remember, this is all in US dollars, guys. This is the US count position. So in Canadian dollars, this 2,000 would be closer to like 2,700 bucks. So it's up quite substantially. So in the other account, my managed account,
I transferred the money out of here I sold from Constellation Brands, and I put it into my RRSP, which I'll get to in a second. We can see I hold more British American tobacco over here. I'm not going to sell all of this yet. This is actually the full position I'd like to see. I've got just enough in here and just enough in the other account that I like it like that. But what I got to do is start mitigating these stocks. I'm trying to keep this account at about 20,000, give or take even. Mind you, I bought Tesla, I believe, last year, so I'm right around the mark where I want to be, and I want to try and like I said, start getting these stocks into my tax-free savings account, because these are the dividend stocks I want to be paid tax-free. So I'm going to sell some Apple off sometime soon here, probably in the next year, whenever it hits those highs that I want to see. I'm going to get out of it and use that money to buy MO. But in the meantime, I'll hold MO here and just keep it just in case it decides to do any high-flying weird stuff. It's nice to hold on to these stocks that I think are cheap. I just don't want to have to pay taxes on them. So I'm going to hold them for now, just to collect the dividends, start migrating them in a tax-free savings account, and I'm going to start migrating some of these positions into my RRSP. And what I mean by migrating to my RRSP, I mean buying safe, reliable long-term investments. So I actually just bought VFV, a company I've talked about, which is the Canadian version of the S&P 500 index. And when I say Canadian version, I don't mean Canada's S&P 500, because that is called, what is that called? That's called S&P TSX Index. So essentially that would be the largest companies in Canada put into an index fund. But no. This is the US index in Canadian dollars. This was only introduced 5 years ago, and it has had a rate of return of 80%. But I honestly think that has to do with the Canadian dollar dropping as much as it has. So we can see this fund, and it's obviously got like a... So this is the safest investment any human could ever make, possibly. In Canadian dollars, though, I don't know whether that's the full potential of it, but I just like the fact that Vanguard is allowing you to buy the S&P 500 index with Canadian dollars. It really helps out. And if we take a look at this, guys, we can see that the 5-year rate of return, this account has only existed for 5 years, by the way, has literally been absolutely absurd. It's been 80% return. So I bought it at all-time highs. Some of you might think I'm nuts buying the markets at all-time highs. I'm currently down $4 or 0.10%. But what I'm gonna do is and also buying this in Canadian dollars mitigates you from Canadian dollar fluctuations or US dollar fluctuations. But I still think that gets evaluated in this overall share price. But again, let's go back to what I'm talking about here, guys. The reason I overpaid for these, I just wanted to get this ripped off like a Band-Aid. This is an account I will not be touching until I'm 65, and I'm going to use this to basically get into real estate, which is why I've been talking about real estate. So essentially this 4,116, yeah, I bought it at all-time highs, but it's not my only tranche here, guys. I'm going to be purchasing this continually going forward. I'm going to try and get about 10,000 to 15,000 in this position alone, and then I'm going to buy one other index, which I'm not sure what that index will be. I told you guys that I might use the Vanguard, the VOO, the US version of this index, just because I feel like they're some of the safest investments. They're the best growing investments compared to even the Canadian indexes. And I feel like VOO would mitigate Canadian dollars as well. So I would actually have US holdings in this US part of this account. As we can see, I have that as well. And that way I'm holding on to US dollars, collecting US dividends, and collecting Canadian dividends as well. So that way I get a little bit of both. That's the way I like it. I like having a little bit of US dollars in my wallet and a little bit of Canadian dollars in case I go to the US, which I will be very soon, which this is a reminder to tell you guys. So coming up, guys, you can actually find me September 26th or 27th. Sorry, I'm performing on the 26th. The 27th, I will be performing at Stocktoberfest. StockTwits actually invited me. I'm booking the plane tickets probably tomorrow, and you guys will actually be able to find me at Stocktoberfest. If you don't know what Stocktoberfest is, guys, you can come check it out here. The StockTwits, one of my favorite forums I've used for the last 4 or 5 years, has actually invited me out to come and do a talk at their basically stock conference, and it's gonna be in San Diego, so I'm gonna fly down for a day. I'm gonna do a quick talk. My girlfriend's gonna come and help me mitigate some of the logistics behind traveling and getting all this resolved, because she is much of a world traveler and she understands these in and outs of airports. It's really nice knowing somebody that knows the good airports, the good flights. It really helps, especially when you start getting into more international work. But these guys are actually covering my flight down to do a fun magic performance and a talk. If many of you don't know, I'm a full-time magician and I love trading. So it's kind of neat to see both my worlds colliding, and I am so looking forward to joining Stocktoberfest this year. And I don't know if you guys are going or not. I'm not trying to over promote it here. I just think it's going to be an amazing adventure and something different, so you can check that out as well. I hope you guys enjoyed this video. Remember to slap a like and consider subscribing if this is your interest to learn about stocks in this way. And I'm in Canada, so it's nice getting a Canadian perspective as well. But stay cool, guys. Stay awesome. I look forward to chatting to you real soon.